The market in 2024 looks unstoppable, at least on the surface. Stocks are soaring, valuations are exploding, and the narrative of endless innovation has pulled investors into a trance. Everywhere you look, optimism is treated as certainty and speculation is mistaken for inevitability. But beneath the euphoria lies a dangerous distortion, the same silent buildup that has preceded every major collapse in modern financial history. What looks like strength is actually fragility. What looks like unshakable dominance is, in reality, the final stage of a bubble fueled by blind faith, cheap money, and the belief that the laws of valuation no longer apply. And it is this illusion that will ultimately trigger the devastating 70% collapse coming for the market's biggest giants by 2025. The core problem is not the companies themselves. It is the way the market prices them in an era defined by unprecedented liquidity and narrative-driven investing. When interest rates hover near zero, capital becomes reckless. Investors chase future fantasies instead of present realities, bidding up asset prices far beyond anything justified by earnings. That is the textbook definition of a bubble. And in the case of several of the market's most celebrated companies, the warning signs aren't subtle, they are flashing. Consider the explosive rise of Nvidia. Its climb has been one of the most dramatic in market history, propelled by the global rush into artificial intelligence. As the primary supplier of high-end GPUs, Nvidia became the symbol of the AI revolution. In 2023 and 2024, its market capitalization surged at a pace that outstripped even the most optimistic projections for its long-term profitability. The prevailing narrative paints the company as the irreplaceable backbone of the AI economy, with demand for its chips framed as virtually infinite. In reality, Nvidia's valuation reached levels that defy financial logic. Its price-to-earnings ratio repeatedly pushed past 70x and even approached 100x forward earnings at its peak. For these valuations to hold, the company would need to sustain extraordinary growth and maintain exceptional margins for decades, an expectation no company in history has ever achieved. The AI sector itself remains young, volatile, and ripe for competition. As foundational models become more commoditized and rivals accelerate their development, Nvidia's pricing power will inevitably face pressure. The market effectively priced the entire future of AI into a single stock, ignoring the competitive cycles and technological shifts that have reshaped every innovation boom before. Apple presents a different story, but the same underlying distortion. For years, it has been regarded as the safest company in the market, an unbreakable ecosystem with unmatched brand loyalty. Its steady growth, reliable earnings, and expanding services business have created a narrative that Apple is a perpetual growth engine insulated from economic cycles. Yet its valuation tells a different story. With a market capitalization frequently exceeding $2.5 trillion and a PE ratio rising into the high 20s or 30s, Apple is priced like a young, rapidly expanding company rather than a mature one. Its flagship product, the iPhone, has reached saturation in developed markets, and innovation in its product lines has become incremental rather than transformational. The services division is growing, but at a slowing rate. To justify its lofty valuation, Apple would need to break into entirely new multi-trillion-dollar markets with the same success it enjoyed in the smartphone era, an assumption that ignores competitive, regulatory, and consumer spending constraints. The stock is no longer priced strictly on earnings. It is priced on the belief that Apple's brand alone can drive limitless future expansion. Then there is the most extreme case, Tesla. Its story is legendary: disruption, innovation, and a bold vision of the future. But its stock valuation has long drifted far outside traditional financial metrics. Investors have embraced the idea that Tesla is not just an automaker, but a robotics company, an AI company, an energy company, a software company, and an autonomous driving pioneer all at once. The expectation has been nothing less than perfection across every frontier. The numbers reveal how unrealistic this faith has become. Even during periods of profitability, Tesla's PE ratio has often been in the hundreds and at times exceeded 1,000x forward earnings. Its peak market capitalization rivaled that of the entire global automotive industry combined, despite producing only a fraction of the vehicles. This pricing assumes total dominance in electric vehicles, autonomy, robotics, and energy storage simultaneously. But competition is intensifying from every direction. Established automakers have accelerated their EV strategies, and new entrants are rapidly improving. Margins are tightening, growth rates are decelerating, and the industry is inherently cyclical. Tesla's valuation has been buoyed not by fundamentals, but by belief. Belief that leaves the stock exceptionally vulnerable to even minor disappointments. The common thread connecting these inflated valuations is the detachment from fundamental investing. When interest rates are artificially low, the time value of money collapses, making future earnings appear far more valuable than they truly are. Investors start to justify sky-high prices through speculation rather than evidence, creating a cycle where rising prices fuel even more demand. It becomes a self-reinforcing loop. The higher the stock goes, the more inevitable its rise appears. This illusion of invincibility is what has fueled every major asset bubble, from dot-com stocks to housing. History teaches the same lesson repeatedly. Whenever markets abandon fundamentals in favor of narratives, they drift into dangerous territory. Each time, a new paradigm argument emerges, claims that technology, innovation, or unique economic circumstances make the old rules irrelevant. But the old rules always return. Markets always revert to intrinsic value. And the more extreme the deviation, the harsher the correction. Today's conditions mirror those that preceded every major crash. The valuations are stretched, the narratives are euphoric, and the monetary environment that inflated these prices is shifting. As liquidity tightens and the cost of capital rises, the market will be forced to confront reality. When that happens, the companies that flew highest on speculative enthusiasm will fall the hardest. The stage is not just set for a correction, it is set for a historic unraveling of some of the market's most celebrated giants. The cracks in the global financial system are widening faster than most investors can see, and the illusion of unstoppable growth is about to collide with reality. The soaring valuations of major companies are not isolated success stories, they are warning signals flashing against an increasingly unstable macroeconomic backdrop. The forces building beneath the surface are setting the stage for a catastrophic market reset, one that could drive a 70% correction by 2025. What OS coming is not a mild slowdown or a soft landing. It's a systemic shock years in the making. For more than a decade, the world was flooded with cheap money. Quantitative easing after the 2008 financial crisis, followed by the unprecedented stimulus unleashed during the pandemic, created an environment where near zero interest rates and abundant liquidity became the norm. Asset prices surged far beyond their fundamental value, fueled by a monetary environment that encouraged risk-taking and speculation. Today, that environment has vanished. The rapid escalation of interest rates, rising from near 0% to over 5%, is a shockwave still rippling through the global economy. Higher rates hit valuations in several critical ways. They increase the discount rate used to calculate the present value of future earnings, making long-term growth stories far less attractive. They raise the cost of capital, restricting companies' ability to borrow, expand, or buy back shares, and they strengthen the appeal of risk-free assets. When short-term treasuries offer yields above 5%, investors demand significantly higher returns on equities, especially those priced for decades of future growth. The result is downward pressure on valuations across the board. Alongside rate hikes, central banks have shifted into quantitative tightening, shrinking their balance sheets and draining liquidity from the financial system. When the supply of capital contracts, markets lose one of the core engines that pushed asset prices upward for years. The full impact of this tightening is delayed, and much of the pain is likely to hit in 2025 as liquidity conditions worsen. This tightening cycle is unfolding within a global environment that is already fragile. The world is drowning in debt at every level, sovereign, corporate, and household. Years of borrowing at ultra-low rates created an ecosystem of zombie consortium companies that could only survive under cheap financing. As rates rise, their debt becomes unmanageable. Defaults, restructurings, and bankruptcies will ripple outward, impacting suppliers, workers, and credit markets. Inflation remains stubborn despite aggressive central bank intervention. With real purchasing power eroding, consumers have begun cutting back on discretionary spending. Higher borrowing costs on homes, cars, and credit cards push households toward retrenchment, ending the brief post-pandemic surge in consumption. This shift is especially damaging to companies dependent on high-margin discretionary purchases. Layered on top of these economic strains is a level of geopolitical instability not seen in decades. Conflicts in Eastern Europe and the Middle East, increasing tensions between major global powers, and widespread disruptions in global supply chains are creating an unpredictable and volatile environment. Efforts toward deglobalization further amplify supply risks. Any disruption to advanced semiconductor manufacturing or major trade routes could trigger significant financial and operational fallout for companies deeply reliant on complex global networks. The combined pressures of higher rates, stubborn inflation, global debt burdens, and geopolitical tensions have reshaped consumer behavior. What was once a wave of revenge spending has turned into a period of caution, prioritizing essentials over indulgence. Higher financing costs make big-ticket purchases less appealing, tightening demand in several high-growth markets. All of these macroeconomic forces form a perfect storm that threatens the most richly valued and growth-dependent companies. As capital becomes more expensive, liquidity shrinks, and global growth slows, the tolerance for extreme valuations declines sharply. When investors shift from a risk-on mindset to risk-off preservation, the repricing can be brutal. What's coming is not a reaction to a single earnings miss or a bad quarter. It is a repricing of risk across the entire global financial system. The companies that soared during the era of easy money are also the most vulnerable. now that the foundation supporting their valuations has been removed. Their market prices reflect a future free of inflation, interest rate pressures, and global instability, conditions that no longer exist. A reversion to the mean is unavoidable. As investors collectively recognize that the economic landscape has fundamentally changed, a sharp downward adjustment becomes not only possible but mathematically likely. Years of speculative excess cannot unwind slowly. They collapse in compressed cycles, and that collapse is already starting to take shape. The calm at the top of the market always feels safest right before the ground gives way. Nvidia, Apple, and Tesla look invincible today, icons of innovation, technology, and cultural dominance. But the forces gathering beneath them are powerful enough to shatter even the strongest illusions. What appears to be unbreakable stability is actually a fragile equilibrium held together by hype, cheap money, and unsustainable assumptions. And once the pressure points snap, the very characteristics that push these giants to the top will accelerate their fall. The vulnerabilities embedded within these companies are not abstract risks or distant theoretical threats. They are active fault lines, widening under the weight of a tightening economy and shifting sentiment. Each company is perched atop a valuation that assumes flawless execution, endless demand, and unchallenged dominance. Yet each is exposed to critical weaknesses that will not survive the economic and competitive realities unfolding now. Nvidia's meteoric rise has been fueled by the AI boom, but every hype cycle follows a predictable arc. A breakthrough sparks excitement, expectations inflate beyond reason, and eventually the market realizes adoption is slower, harder, and far more competitive than the narrative promised. Nvidia is at the peak of inflated expectations, but the trough of disillusionment is coming fast. Its revenue is dangerously dependent on a small set of hyperscalers, Microsoft, Google, AWS, Meta, all of which are aggressively developing their own custom AI chips. As these companies transition to their own silicon, they will reduce purchases from Nvidia, eroding the market share and pricing power that created its seemingly insurmountable lead. The notion that AI hardware will remain a goldmine is equally fragile. As AI models become standardized and democratized, the underlying hardware inevitably commoditizes. Competitors like AMD, Intel, and a wave of well-funded startups are racing to break Nvidia's moat, while semiconductor demand itself remains deeply cyclical. Any slowdown, whether from overcapacity, economic contraction, or a shift in AI design, would hit Nvidia at the exact moment its valuation assumes uninterrupted explosive growth. Add the risk of geopolitical disruptions to Taiwan, the core of its manufacturing pipeline, and Nvidia becomes far more exposed than the market acknowledges. Once the hype cycle cools and customers shift to in-house solutions, the company's valuation will reset brutally. Apple's empire looks timeless, but its vulnerabilities are now sharper than at any point in the last decade. The iPhone, the engine of Apple's financial dominance, has reached peak saturation. Global smartphone markets are stagnant, and Apple increasingly relies on existing customers upgrading rather than new users joining the ecosystem. Incremental improvements no longer justify premium pricing, especially when consumers are pressured by higher interest rates, rising debt burdens, and economic uncertainty. A 1,000 pluses upgrade becomes a luxury that millions will delay. Regulation adds an even heavier weight. Apple's services segment, especially the App Store, has been essential to its growth narrative, but governments around the world are challenging the walled garden model that made those margins possible. Antitrust lawsuits, forced changes to payment systems, and the push for sideloading threaten to weaken Apple's most profitable business line. Meanwhile, Apple's reliance on China spans both manufacturing and sales, exposing it to geopolitical shocks, supply chain disruptions, and competitive pressures from increasingly capable Chinese brands. The company's valuation assumes its ecosystem is untouchable, but the world is becoming less tolerant of monopolistic control and luxury spending. That assumption is now dangerously outdated. Tesla's valuation rests almost entirely on a narrative: technological leadership, unstoppable demand, and an inevitable autonomous future. But the automotive industry is catching up fast. Legacy automakers such as Ford, GM, Volkswagen, Hyundai, and especially BYD are producing electric vehicles at large scale and increasingly at lower cost than Tesla. The first mover advantage is fading, while Tesla's once wide technological lead has narrowed. To preserve volume, Tesla has triggered global price cuts, sacrificing margins the market had assumed would remain premium. As competition intensifies, further compression is unavoidable. The slowdown in EV demand is another threat. Early adopters have already bought in, government incentives are fading, borrowing costs are high, and charging infrastructure still lags behind expectations. The EV boom has already begun to deflate. Tesla's long-promised breakthrough, full self-driving and a global robotaxi network, remains unachieved and heavily scrutinized by regulators. Each delay erodes the valuation built on those expectations. Safety investigations, recalls, and regulatory pushback only add more pressure. The The market priced Tesla as if these future technologies were guaranteed. Reality is proving far more complicated. When these individual vulnerabilities collide with the broader macroeconomic stress building in the system, the result is a perfect storm. The synchronized fall of these companies is not an outlandish scenario. It is a predictable outcome when overvaluation meets tightening liquidity and shifting psychology. Just as the Nifty 50 once felt untouchable before collapsing 50–90%, and just as the tech leaders of the dot-com era fell 70–80% despite strong fundamentals, today's market darlings are positioned for the same fate. The psychology of bubbles is painfully consistent. In euphoric phases, investors anchor to past highs, ignore risks, and chase momentum. They seek confirmation of bullish narratives and dismiss warning signs. Prices rise because they've been rising. When the narrative finally breaks, triggered by an earnings miss, a policy shift, a credit event, or geopolitical shock, the reversal is swift and brutal. Stop losses trigger, margin calls cascade, and institutional investors dump positions to meet redemptions. Retail investors, heavily exposed through commission-free platforms and social media-fueled optimism, panic and flee. Index funds amplify the sell-off as their rule-based mechanisms force proportional reductions. The same forces that lifted Nvidia, Apple, and Tesla to unprecedented heights will accelerate their plunge. History shows that market leaders of major bull runs almost always lead the declines that follow. The collapse feeds on itself. Fear replaces FOMO, liquidity evaporates, and the narratives that once justified extreme valuations turn toxic almost overnight. Given their sheer size, the unwinding of these three companies would ignite selling pressure across the entire market. The triggers for this unwinding are not hypothetical. They are already forming. Stubborn inflation could force the Federal Reserve to maintain high interest rates far longer than expected, or even tighten further. With monetary policy's lag effect peaking in 2025, the wave of corporate bankruptcies, rising consumer defaults, and declining manufacturing activity will place enormous pressure on these high valuation companies. A major geopolitical disruption, whether in Taiwan, the Middle East, or through a cyber attack, could cripple supply chains or spike commodity prices, triggering stagflation and destroying growth assumptions. Even a single earnings disappointment from one of these giants could ripple across global markets as investors reassess the entire tech sector as future. Once the correction arrives, the aftermath will reshape markets for years. Value investing will regain dominance, capital will rotate into neglected sectors such as energy, industrials, and materials, and the inflated returns of the last decade will give way to stagnation or a lost decade of flat performance. Regulatory scrutiny on big tech will intensify, and retail investor behavior will undergo a dramatic reset. Innovation will continue, but investors will demand evidence, profitability, and real market traction, not dreams. This is not a sensational prediction. It is a realistic assessment based on valuation extremes, cyclical patterns, competitive realities, and historical precedent. The illusion of unstoppable growth has blinded the market to the risks building beneath its feet. When the unwinding begins, Nvidia, Apple, and Tesla will lead it, falling not because they are weak companies, but because their valuations are built on expectations no economic reality can fulfill. The smart investor is the one who recognizes the pattern, steps back from the edge, and prepares for the inevitable correction before it arrives.